Welcome to lecture 18 of International Finance, and this lecture is going to be about the determinants of exchange rates. Moving toward the contents, we are going to discuss the factors that affect exchange rates. So why exchange rate would increase or decrease, appreciate or depreciate, what are different factors or determinants that are affecting exchange rates, and some of the determinants are inflation, interest rate, income level, governmental control, and there are others, but these are some of the factors that we are going to explore. So before we start, and we have already discussed multiple times this concept, but for the sake of clarity, because this is going to be used in this lecture, I want to explain the concept of depreciation and appreciation in a currency. So a decline in currency's value is often referred to as depreciation. So for example, if $1 is equal to 160 rupees, and then after a few days, this is the scenario, then we can say that now before $1 was able to buy 160 rupees, now $1 is able to buy 150 rupees, lesser from previous purchasing power of dollar. So that means the currency's value, the value of dollar has decreased. And this is what we call dollar is depreciated. Or the other way around, that rupees have appreciated. So this gives us an idea of appreciation. The increase in currency's value is referred to as appreciation. But normally when we talk about appreciation or depreciation, we prefer to discuss the percentages, and that would be calculated as current minus previous value divided by previous value. So if in this case I wanted to calculate, so the current price, now the price is 150 and previously it was 160. So this is how I would calculate the percentage return. A positive percentage change would means that the foreign currency has appreciated. In this case, the foreign currency was dollars, and we know from our understanding, our common sense, our understanding of exchange rate, that in this case dollar has depreciated. So this answer would obviously be negative, because 150 minus 160 would give you minus 10 divided by 160 would be some answer in negative. So we know that foreign currency has depreciated, right? Now moving towards the understanding of determinants, the basic idea is the demand and the supply of currency. When the demand of currency would increase, the currency value would increase and it would appreciate. If the supply of currency would increase, its value would decrease and it would depreciate. This is the basic idea. But these market forces would always keep this exchange rate in equilibrium. So for example, in this case, this is the equilibrium level, and the quantity demand of this currency, which is pound, and its value is in terms of dollars is given. So now let's move towards the factors that would affect the exchange rate. And some of the factors that we are considering are changes in inflation, changes in interest rate, change in income, the governmental control, and the expectation of the future exchange rate. So let's start with inflation and see how inflation will cause the exchange rate to move? One thing you must understand in simple words is that when inflation increases, the specific currency would depreciate, right? So if inflation increases in US, then dollars would depreciate, right? This is the simple idea, but let's build our understanding on this simple idea. What is the reason, what is the intuition behind this relationship, why there is this relationship of interest and inflation and exchange rate. So what will happen if inflation in Pakistan increases? Imagine now when we are talking about an increase, we are talking about relative change. So for example, previously the inflation in Pakistan is 5%, and the inflation in US is, say for example, 6%. And now, although the US inflation remains same, but the Pakistan's inflation have increased to 10%. This is what we say relative change. We are not talking about the absolute change. Okay, or what we can say is, in another scenario, if Pakistan's inflation have increased to 7% and US inflation have also increased to 8%, then the change in inflation is 2% in both cases, right? So when we are talking about change in inflation, then we are specifically talking about this situation, that the increase in inflation of one country is higher than the increase in inflation of another country, or change in inflation of one country is higher than the change in inflation of another country. Okay, so assume this is the equilibrium position. Previously, the demand and supply of currency and the exchange rate had been set. This is the demand of the dollars and the exchange of rupees versus dollars. Now assume that if inflation in Pakistan increases, what would happen? There would be a shift in the demand curve, and the shift would occur because due to increase in inflation in Pakistan, the Pakistani demand for US good would increase, because the products in Pakistan have their price have increased. So the Pakistani people would increase their demands for foreign products. For example, in this case, we just consider one country, the US. So Pakistan's demand for US good would increase, and therefore it would also cause an increase in Pakistan demand for US dollars. So the demand for US dollar would increase. At the same time, because of this increase in Pakistan's inflation, the US desire for Pakistan's product would also decrease. So US citizens, for them, Pakistani products would get expensive. So they would rather not buy Pakistani products. So if they are not going to buy Pakistani product, the supply of dollar would also shift. And in this way, a new equilibrium would come into place, and this would be the new exchange rate. So in this case, the exchange rate would increase. The home currency would depreciate. In this case, rupees would depreciate. The currencies who's having higher inflation would depreciate, in simple words. So the idea is that if there is inflation, the products of home country would get expensive. People of home country would start buying from another country, and therefore the demand of the currency, of the foreign currency, would increase, and the supply of local currency would also increase. Hence, it would push a downward pressure on the exchange rate, and the currency the country having a higher inflation, its currency would depreciate. What if what will happen if the inflation of US increase? This would have an opposite impact. Obviously, if inflation in US increases, US citizens would start buying products from Pakistan, and hence the demand of uh, dollars would decrease, right? The demand curve would shift inwards or leftwards, and similarly, because of this increase in inflation, the supply of dollars would also increase, and this would put a downward pressure on the US currency, and hence the rupee would appreciate but the dollar would depreciate. So again, in this case, US had higher inflation, that's why its currency depreciated. The second factor that we are considering is interest rate. The simple idea is the country whose interest rate are higher, its currency would appreciate, because more people would want to invest in that country. For example, if Pakistan's interest rate increases, and which had happened in previous years, the interest rate was increased to almost 14-15%, investors from other countries started depositing money into Pakistani banks. By doing so, what they did was their demand of rupees increases. So obviously, to deposit in Pakistani bank, they would have to sell dollars and buy rupees. So when they are buying rupees, the demand of rupees would increase, and when the demand of rupees would increase, the rupees would appreciate, right? So let's look at this. What will happen if the interest rate in Pakistan increases? So this is the equilibrium position. The Pakistani investor would reduce their demand for dollars, right? Previously, if they were investing in other countries, now they would rather invest in their home country, and their demand for, so previously if they were investing in dollars, converting their currency into dollars and keeping them into US banks, now they will reduce their demands of dollar because Pakistan's interest rate is more attractive. And similarly, the demand of dollar would hence decrease, because the foreign investor or US investor would sell dollars and buy rupees to deposit into Pakistani banks. The supply of dollar would also increase. Hence, a new equilibrium would be reached, at which the rupees would appreciate and the dollars would depreciate. How do rupees appreciate in this case? For example, this was the situation over here, and this R1 is, for example, rupees 90 per dollar. So in this case, clearly rupees have appreciated. Now less rupees can buy $1. We require lesser rupees to buy $1. So the simple idea is, interest increases, it would appreciate the currency of the country whose interest have increased. But one thing that we should understand is that we know there is a monetary policy, and when there is higher inflation, to control that higher inflation, the government increases interest. This is their way of controlling inflation. So this higher interest might also represents the possibility that, or the anticipation that, there is going to be a higher inflation. So a relatively higher interest rate may actually reflect the expectation of a higher inflation, which may discourage foreign investors. We know that if there is higher inflation, the currency would depreciate, right? So a higher interest rate also reflects that the interest rates are higher because of higher inflation. So that's why, rather than considering a nominal interest rate, the investor should consider a real interest rate. And real interest rate is equal to this real interest rate is equal to nominal interest rate minus inflation. So in essence, this real interest rate is adjusted for inflation. Now, if this real interest rate is higher, if this has increased, then the investor should invest in this country, in this currency. Relative income level. By income level means the buying power of the people have increased, the income level of the people have increased. If so, what would happen if the general income level of Pakistan or Pakistani citizens has increased? When this would happen, imagine this is the current situation, the equilibrium price that is already there. When the income level would increase, what would happen is that Pakistani citizens would have higher purchasing power. So they would start purchasing foreign products, and hence the demand of dollar would increase and the supply of rupees would increase. So that means this rupees would depreciate and dollar would appreciate, right? Now this is assuming when if there is, if due to this higher income, the people started buying the foreign products. So this would happen if the general income level increases, the exchange rate would increase. Next is governmental control. Now, government may influence the equilibrium exchange rate by using some tactics, that is imposing foreign exchange barriers. For example, in previous example, we said that if income level increased, people would start buying foreign products, right? Now, this would not happen if the government imposed some kind of custom duties on foreign products. This would discourage buying the foreign products. And hence, even though income had increased, this would not lead to the reaction that we have discussed in our previous slide. Similarly, by imposing trading barriers, intervening in foreign exchange markets, they can keep on buying rupees to keep on increasing artificial demand of the rupees, or affecting the macroeconomic variables such as inflation, interest, or the income level. One example that we also discussed in case of interest rate. So if interest rate in Pakistan have increased, but imagine that government have imposed a higher tax on foreigners earning interest income in Pakistan, then even though interest rate have increased, that would not appreciate the rupees, the home currency. We said previously that if interest rate increases, the home currency would appreciate. The currency with higher interest rate would appreciate. But this would not happen if there is some kind of restriction by government. And one of the example of this restriction can be that the government have imposed higher tax rates on foreigners earning interest in home country, in Pakistan. And last factor that we are discussing in this example is the expectation. So there are speculators in exchange market. They buy or sell the currencies in order to earn profit, and they react on news, right? So if there is a positive news about a country, then there is an expectation that its currency would appreciate. If there is a negative news about a country, then it is anticipated that its currency would depreciate. So foreign exchange market react to any news that may have future effect because of these speculators who try to earn profit. Remember, we have a term which is called forex, right? So many institutional investors take currency position based on anticipated interest rate movement in various countries. That is to say that not just individuals, but different institutions, different investment firms or brokerage firms or mutual funds also take currency position in order to earn profit. So if they think that currency, that country is going to go from some political turmoil, then that is a bad news and its currency would depreciate, although the inflation or the interest rate had not changed, but the expectation of the investors in the market have changed.